You're about to discover the most shocking secret hiding in plain sight within our tax system. While working families hand over 40% of their income to Uncle Sam every year, the ultra-wealthy have figured out how to live like kings while paying virtually zero taxes. I'm not talking about some sketchy offshore scheme or complicated tax shelter. This is a completely legal strategy that's been operating right under our noses for over a century. What I'm about to show you will make you question everything you thought you knew about how wealth really works in America. By the end of this video, you'll understand why billionaires can pay lower tax rates than teachers, and why wealth inequality keeps exploding despite all the political promises about tax reform. This strategy is so elegantly simple that a USC law professor had to create a 3-word phrase just to help people wrap their heads around it. He called it borrow until you die, though most people know it by its more famous name. But before we dive into the mechanics, make sure to hit that subscribe button, because understanding how the game is really played could completely change your perspective on money, investing, and why the system seems so fundamentally unfair. The strategy I'm talking about has 3 distinct phases, each one more brilliant and infuriating than the last. The first phase is deceptively simple, but it represents a fundamental shift in thinking that separates the wealthy from everyone else. Instead of earning traditional income that gets taxed immediately, ultra-wealthy individuals focus exclusively on acquiring appreciating assets that generate no taxable income. Think about how different this approach is from the way most people try to build wealth. You go to work, earn a paycheck, and immediately get slammed with income taxes, payroll taxes, Medicare taxes, and whatever your state decides to take. Then you try to save what's left over, maybe contribute to a retirement account, or save for a house down payment. The wealthy completely flip this script. They prioritize purchasing assets that will appreciate in value over decades without generating any taxable events. We're talking about growth stocks that don't pay dividends, real estate that increases in value, art collections, private company shares, and other investments specifically chosen for their ability to grow quietly in the background. Here's the crucial part that most people don't understand. These assets can appreciate for decades without triggering any tax obligations whatsoever. As long as you never sell them, the government can't touch those gains. It's like watching your net worth climb higher and higher while the IRS sits powerless on the sidelines. But you might be wondering how someone actually lives off assets they never sell. After all, you can't pay your mortgage with unrealized capital gains, and grocery stores don't accept stock certificates as payment. This brings us to the second phase of the strategy, which is arguably the most brilliant part of the entire system. Once you have substantial appreciating assets, you can use them as collateral to secure loans. Modern financial institutions have created sophisticated lending products specifically designed for this purpose. Securities-based lines of credit allow wealthy individuals to borrow against their investment portfolios without selling a single share. Here's the beautiful part from a tax perspective. The government doesn't tax borrowed money. Think about that for a moment. If you borrow $1 million against your stock portfolio, that $1 million flows into your bank account completely tax-free. You can use that money to buy houses, cars, vacations, or anything else your heart desires, and the IRS treats it as if it doesn't exist. The terms on these loans are incredibly favorable for wealthy borrowers. Interest rates are often lower than traditional bank loans or home equity lines of credit. Lenders might advance 70 to 80% of the value of stocks and bonds, and even more for treasury securities. The larger your portfolio, the better rates you can negotiate. Some wealthy individuals can borrow at rates as low as 2 to 3% annually, but here's where it gets even more interesting. While you're borrowing against your assets, those assets continue to grow. If your portfolio is earning 8% annually and you're paying 3% interest on your loan, you're still coming out ahead. Your wealth keeps compounding while you access liquidity without any tax consequences. This creates a perpetual cycle that can theoretically continue indefinitely. As your assets appreciate, your borrowing capacity increases. You can take out larger loans or refinance existing debt at better terms. Meanwhile, you're living off borrowed money while your actual wealth grows untouched in the background. Now you might be thinking this sounds too good to be true. What happens when the loans come due? What if the assets decline in value? What about all that accumulated debt? This is where the third phase comes into play, and it's the part that reveals just how tilted the playing field really is. The final phase isn't just about death. It's about the culmination of a wealth preservation strategy that can span multiple generations. When someone using this strategy passes away, their heirs inherit the appreciated assets through something called stepped-up basis. This is where the tax code essentially gives the wealthy a massive gift that most people don't even know exists. Under current federal tax law, when you inherit assets, you receive them at their current market value, not at the price the original owner paid for them. All those capital gains that accumulated over decades simply disappear for tax purposes. If your grandmother bought stock for $10 a share 50 years ago and it's worth $500 when she dies, you inherit it as if she paid $500 for it. All that appreciation becomes tax-free forever. This means the heirs can immediately sell the inherited assets without owing any capital gains taxes. They can use the proceeds to pay off any outstanding loans, and whatever is left over becomes their tax-free inheritance. The family wealth not only survives the transfer between generations, but it often emerges stronger than before. Let me walk you through a real-world example that shows just how powerful this system can be when you have the money to make it work. Meet Sarah, a successful entrepreneur who managed to accumulate $1 million through years of building and selling businesses. Sarah could do what most people do with a windfall like this. She could buy a fancy house, some luxury cars, maybe take a few expensive vacations, and slowly watch her nest egg shrink as she pays taxes on any investment gains along the way. But Sarah understands the game that wealthy people play, so she takes a completely different approach. Instead of spending her $1 million, Sarah invests it in a diversified portfolio of appreciating assets, growth stocks, real estate investment trusts, private equity shares, and other investments specifically chosen for their potential to increase in value without generating much taxable income along the way. She's not looking for dividends or rental income that would trigger immediate tax obligations. She wants pure tax-deferred appreciation. Here's where the math becomes absolutely ridiculous. Sarah's portfolio grows at a conservative 7% annually, which is actually below the historical average for diversified stock investments. After 10 years of compound growth, her $1 million portfolio is now worth nearly $2 million. That's a gain of almost $1 million that has never been touched by the tax man. If Sarah were to sell these assets right now, she'd face a brutal tax bill. Between federal capital gains taxes at 20%, and state capital gains taxes that could add another 5%, she's looking at paying roughly $250,000 to Uncle Sam. That's a quarter of her entire gain disappearing into government coffers just for the privilege of accessing her own money. But Sarah doesn't sell anything. Instead, she walks into her private bank and uses her $2 million portfolio as collateral for a securities-based line of credit. The bank, knowing that her assets are solid and that wealthy clients like Sarah represent extremely low risk, offers her access to up to 70% of her portfolio's value. That means Sarah can borrow up to $1.4 million without selling a single share of stock. The interest rate on this loan, let's say it's around 6.5% annually, so Sarah is paying roughly $91,000 per year in interest to access $1.4 million in cash. Compare that to the nearly $300,000 tax bill she would have faced by selling her assets. She's effectively deferring a massive tax hit by paying a much smaller annual cost. But it gets even better. While Sarah is paying 6.5% interest on her loan, her underlying portfolio continues to grow. If her investments generate an 8% annual return, which is right in line with historical averages, she's actually making a solid profit on this arrangement. Her portfolio grows by $160,000 per year, while she pays $91,000 in interest. She's netting $69,000 annually just by using debt instead of selling assets. This is where the strategy becomes almost comically unfair to everyone else. Sarah is now living off borrowed money that the government can't tax, while her actual wealth continues to compound in the background. She can buy houses, cars, take vacations, invest in new businesses, or do whatever she wants with that $1.4 million, and none of it shows up as taxable income. As her portfolio continues to grow, her borrowing capacity increases as well. 5 years later, when her assets are worth $3 million, she can refinance her existing debt and potentially borrow even more money at even better rates. The cycle continues indefinitely, with Sarah accessing larger and larger amounts of tax-free cash, while her underlying wealth grows faster than her debt. This has to catch up with her eventually, right? What happens when Sarah dies and all these loans come due? Won't her estate have to sell assets and pay massive taxes to settle the debt? This is where the final phase reveals just how tilted the playing field really is. When Sarah passes away 30 years later, her portfolio has grown to $8 million through decades of uninterrupted compound growth. She's accumulated several $1 million in outstanding loans over the years, but her assets have grown much faster than her debt. Her heirs inherit the entire $8 million portfolio at its current market value through stepped-up basis rules. Here's the part that will make your blood boil if you've ever paid capital gains taxes. All those decades of appreciation from the original $1 million to the final $8 million simply vanish for tax purposes. Sarah's heirs can immediately sell $4 million worth of inherited assets to pay off the outstanding loans, and they owe absolutely zero in capital gains taxes. The remaining $4 million becomes their tax-free inheritance. Sarah started with $1 million and managed to provide her family with a $4 million inheritance while living lavishly off borrowed money for 30 years. The total tax bill on this entire transaction, essentially zero. Meanwhile, if you or I tried to build wealth through traditional methods like earning income and saving after tax dollars, we'd be paying taxes at every step of the process. The scale at which this strategy operates in the real world is absolutely staggering. Securities-based lending has become a massive industry specifically designed to facilitate this type of tax avoidance. Major financial institutions now offer these services as standard products for high-net-worth clients. The minimum portfolio size to access these lending programs varies by institution, but most require at least $1 million in investable assets. Some premium services require $5 or $10 million to get started. Once you meet these thresholds, the banks compete aggressively for your business, offering increasingly favorable terms as your wealth grows. Interest rates on securities-based loans are typically tied to benchmark rates plus a spread that decreases as your borrowing capacity increases. Wealthy individuals with $50 million portfolios might pay 2 percentage points less in interest than someone with a $5 million portfolio. The system literally rewards you for being richer. The types of assets that qualify as collateral have expanded dramatically over the past few decades. Traditional stocks and bonds have always been accepted, but now you can borrow against private equity investments, hedge fund shares, real estate investment trusts, and even certain types of collectibles and artwork. The financial industry has essentially created a lending product for every type of asset that wealthy people like to own. What makes this even more infuriating is how the strategy scales with wealth. Someone with $10 million in assets can borrow $7 million and live better than most people ever will while paying minimal taxes. Someone with $100 million can access $70 million in tax-free liquidity and still watch their net worth grow every year. The more money you have, the more effectively this strategy works. The compounding effect over multiple generations creates dynastic wealth that becomes almost impossible to erode through taxation. Each generation inherits assets at stepped-up basis, continues the borrowing cycle, and passes even more wealth to their children. Meanwhile, families trying to build wealth through earned income face tax rates that can exceed 40% when you combine federal and state obligations. This explains why wealth inequality has exploded over the past several decades despite periodic efforts to raise taxes on the wealthy. You can't tax wealth that never gets realized as income. And you can't collect capital gains taxes on assets that never get sold. This strategy allows wealthy families to effectively opt out of the tax system that everyone else participates in. The psychological impact of understanding this strategy can be profound, especially if you've spent your entire life believing that everyone plays by the same financial rules. It's like discovering that while you've been playing checkers, the wealthy have been playing three-dimensional chess with a completely different set of rules that nobody ever explained to you. The most frustrating part isn't just that the strategy exists, it's that our entire political and media discourse around tax policy completely misses the point. Politicians argue about raising or lowering tax rates while the ultra-wealthy sit back and laugh because tax rates are irrelevant when you never actually realize any taxable income. You could raise capital gains taxes to 90% tomorrow, and it wouldn't affect someone using this strategy one bit because they never sell their assets. This creates a bizarre situation where middle-class families earning $60,000 a year pay higher effective tax rates than billionaires who control assets worth more than the GDP of small countries. The teacher, the nurse, the engineer, and the small business owner all get hammered with income taxes, payroll taxes, and property taxes while watching headlines about how the richest people in America paid less than 1% of their wealth in taxes. What's even more maddening is how the financial media covers this topic. They'll run breathless articles about tax avoidance strategies for regular people that might save you a few $100s on your annual tax bill while completely ignoring the elephant in the room. Meanwhile, wealth management firms are quietly marketing securities-based lending products to their high-net-worth clients like they're selling miracle cures. The marketing materials for these services read like something out of a fantasy novel. They promise tax-efficient liquidity solutions and wealth optimization strategies that allow you to maintain your investment positions while accessing capital for lifestyle and investment needs. It's corporate speak for helping rich people avoid taxes while everyone else foots the bill for running the country. Here's where things get really interesting from a practical standpoint. This strategy isn't just some theoretical concept that exists in academic papers and investigative reports. It's actively shaping investment behavior and market dynamics in ways that most people don't recognize. When you understand that wealthy investors never plan to sell their assets, it completely changes how you think about stock valuations and market bubbles. Traditional investment analysis assumes that assets will eventually be sold and profits will be realized. But if the largest holders of appreciating assets never sell them, what does that do to market dynamics? It creates artificial scarcity and upward pressure on prices because a significant portion of the supply is permanently locked away. The wealthy aren't just avoiding taxes on their gains, they're potentially inflating the value of everyone else's investments by reducing the available supply. This has profound implications for retirement planning, college savings, and any other long-term financial goals that regular families are trying to achieve. When a substantial portion of the market is effectively removed from circulation, it can drive prices higher than they would be in a truly free market. The irony is that while wealthy individuals are using this strategy to avoid paying their fair share of taxes, they're also benefiting from the infrastructure, legal system, and social stability that those tax revenues are supposed to support. They're essentially free riding on a system that everyone else is paying to maintain. Consider the broader economic implications of this strategy. When the wealthy avoid paying taxes on their wealth accumulation, that burden shifts to everyone else. Working families end up paying higher rates to fund the same government services and infrastructure that benefit everyone, including those who are gaming the system. This creates a vicious cycle where the wealthy get wealthier while the tax burden on everyone else increases. It's a wealth extraction mechanism that operates largely invisibly, hidden behind complex financial instruments and legal structures that most people never learn about. The educational system certainly doesn't teach this stuff in high school economics classes, or even in most college finance programs. You have to dig deep into advanced tax law and wealth management strategies to understand how this all works. This information asymmetry is part of what maintains the system's effectiveness for those who benefit from it. Understanding this strategy also reveals why certain political debates around tax policy are essentially theater. When politicians talk about closing loopholes or making the wealthy pay their fair share, they're often focused on income tax rates rather than addressing the fundamental structure that allows wealth to compound tax-free indefinitely. Real tax reform would need to address the stepped-up basis provision that wipes out capital gains at death, or implement some form of wealth tax that captures unrealized gains. But these are politically difficult changes that face enormous opposition from those who benefit most from the current system. The strategy also explains why wealth inequality has become so extreme and why social mobility has declined. When you have one set of rules for people who earn their money through work and a completely different set of rules for people who own appreciating assets, you create a two-tiered system that becomes increasingly difficult to escape. For most people, the practical takeaway isn't that you can immediately implement this strategy yourself. The reality is that it requires substantial wealth to make it work effectively. But understanding how it operates can inform your own financial decisions and help you think differently about investing and wealth building. If you're starting out, focus on building wealth through appreciating assets rather than just earning income. Even if you can't access the same sophisticated lending products that billionaires use, you can still benefit from the tax advantages of holding investments for the long term rather than trading frequently. The key insight is that the tax system heavily favors wealth over work, and understanding this reality can help you structure your finances accordingly. Instead of focusing solely on increasing your income, think about how to convert that income into appreciating assets that can grow with minimal tax consequences. This doesn't mean you should take on dangerous levels of debt or make risky investments you don't understand, but it does mean recognizing that the wealthy play by different rules and structuring your financial strategy accordingly, even if you're operating at a much smaller scale. So there you have it, the strategy that allows the ultra-wealthy to live like royalty while paying virtually nothing in taxes isn't some conspiracy theory or financial fairy tale. It's a perfectly legal tax avoidance technique that's been hiding in plain sight for over a century. Now you understand why billionaires can pay lower tax rates than their secretaries and why wealth inequality keeps exploding despite all the political theater about tax reform. The game was rigged from the start, and most of us didn't even know we were playing by different rules. This knowledge won't instantly make you wealthy, but it will change how you think about money, investing, and the fundamental fairness of our economic system. The next time you hear politicians debating tax rates or see headlines about billionaire tax bills, you'll understand the real story behind the numbers. The question now is what we do with this information. Do we accept that this is just how the system works, or do we demand changes that create a more level playing field? That's a decision each of us has to make, but at least now you're armed with the knowledge to make that choice with your eyes wide open.